Namaskar guys, this is Stock Yatra and we are looking at the series of lectures on the basics of the Indian stock market. We are here with video number 7 where we'll be discussing the different corporate actions and the important dates that we need to look at in the corporate actions. We'll move right on. Corporate actions. So corporate actions are the actions taken by a company. Most companies, they hold board meetings and they decide with the board members if they want to perform a certain corporate action. These corporate actions, the most useful ones for us are mentioned here. There are 5 of them. We'll be looking at what is dividend. We saw the what is dividend in the first video. We'll look at it in detail. So dividend is a part of profit that is given to the shareholders so this part of the profit is not a fixed value, it is not a fixed value, nor is it mandatory for the company to yield dividends yearly. It is entirely optional and up to the company to either give dividends and also to determine how many times and how much dividend are they going to give to the shareholders. The major aim of providing dividends is to show that they are making a profit in the company, boost confidence or boost demand for their share prices with the shareholders, because these dividends are additional income that we look at. Our main aim or target in the stock market was appreciation in a stock value. So we are buying at a low price, selling at a higher price. That is what was our main aim. This dividend comes as an additional bonus income for holding the shares of that particular company. Not every company provides dividends. Most companies that provide dividends are government backed companies. So this dividend is announced in this particular format, rupees X per share, or it can also be announced in percentage of the face value. This can be a 200% dividend, it can be a 500% dividend. So all these are based on face value and not on the LTP. Remember this. It can also be mentioned as rupees X per share. So for every share that you hold, if the dividend of a particular company was announced as 2 rupees per share, so for every share you hold, you will be receiving 2 rupees. If you are holding 1000 shares, so the total dividend would be 2000 rupees. This is what is dividend. Next, we'll look at what is stock split and bonus issue. Stock split, just like the name says, a particular share which was trading at a value X will be split into n number of shares to reduce its value to X by n. For example, if a share was traded at 100 rupees and there is a 1:5, notice the format here, X is to Y. In all these 3 formats, X is the number of existing shares or the shares that you are holding. Y will be the new action taken place, number of new actions or number of new shares that are being added. So X will be the total number of existing shares. So with this, if it is a 1:5 split, each share will be split into 5 parts, which means that this 100 rupee share will be split into 5 parts. but the market cap has to remain same. It is not supposed to change, because the entire valuation of a company should be changed by this demand and supply of the share prices, and not by something the company announces. Cut this part. So this 100 rupee share is split into 5 parts. But keep in mind, market cap remains same. It does not change, because the entire valuation of the company will change if the market cap changes. This is not supposed to happen. That is why market cap remains same. But with an increasing number in the shares, to keep the market cap constant, what happens? The share value is divided proportionately, and the new share value will become 20 rupees. This is a stock split. The difference between a stock split and bonus issue is that in both, the market cap remains same, and number of shares being circulated in the market is increasing. Market cap remains same. But what is the difference between a stock split and a bonus issue? Let us look at this table here. Here we can see that in a stock split, you can see face value is split into two. This is a 1:2 split. So the face value of 10 rupees is split into 5 rupees. The number of shares is at 2 crores. After being split into two parts, the number of shares becomes 4 crores. The share capital remains same at 20 crores. The reserve shares, the number of shares that are not put in the public market as of now, is termed the reserve shares. These reserve shares remain same. So the total equity value remains same at 80 crores. Coming to bonus issue, this is a 2:1 bonus issue. You can see here that the format for a bonus issue is just the reverse, y:x. So if it is a 2:1 bonus issue, it means that for every one share that you are holding, 2 new shares will be given to you. Right? So in bonus issue of 2:1, you can see that face value remains same, because the stock is not splitting into two parts. New shares are put into the market. But where do these new shares come from? It is derived from the reserve shares. So as you can see here, the reserve capital of 60 crore has come down to 20 crore. So the two new shares, initially there are 2 crore shares in the market. 2 new shares are put in for every single share. So 2 crore for 2 crore shares, 4 crore shares are added. So the total number of shares will be 6 crores. Share capital is increasing, but in turn reserve capital is decreasing, and the total equity capital is remaining same at 80 crores. This is the difference between a stock split and bonus share. The aim for performing stock split and bonus issue is that it increases the number of shares. So more people or more shareholders participate in the transactions of that particular company's share. Likewise, in a stock split, the value or the price CMP of the stock comes down. This makes the stock more affordable for small time investors. The increase in the number of participants in a share will increase stability and reduce volatility. Likewise, increase in affordability will also increase in number of participants. This is the aim of a stock split and a bonus issue. Rights issue. Now, rights issue is similar to an IPO, but here, just like how a bonus issue is given, rights issue, this bonus issue is given for free. rights issue is given at a discounted price. That is the difference between a bonus issue and a rights issue. So anybody who's holding X number of shares will be offered Y number of shares at a discount price. Now, a discount means that if the CMP of that particular share, CMP of that particular share is at 100 rupees, discount will be any price less than 100, and a premium means that any price more than 100. So premium is on the higher side, discount is on the lower side, right? So rights issue, people who are already holding the shares of a particular company will be able to buy new shares of that company at a discount price. If the price CMP of that share was at 400 and the company issues a rights issue, so people will be able to buy it at a, let us say, a discounted price of 300 rupees. So they can make a profit of 100 rupees per share. Again, the format is Y is to X, where X is the number of shares that you are holding and Y is the number of shares that you are eligible to buy under rights issue. Now, shares buyback is just the opposite of rights issue. The company will offer to buy back shares from the shareholders, from the shareholders at a premium price. So if the CMP of the share was 400 and the company announces a buyback, it will buy it back at any price above 400. Let us say it is buying it back at 550. There is a profit of 150 rupees that you can make. Again, this is only issued to eligible for existing shareholders of that particular company's shares. The aim, all these 5 corporate actions that we saw are positive actions. They have a positive impact on the share price. They are going to naturally increase. The reason here is that behind each of these corporate actions, it indicates an increased confidence of the promoters or the company in their own shares. So the share price is bound to perform well, and that is the reason the demand also increases and the share price is going to eventually increase. But the importance of dates in corporate action is that, let us take a hypothetical situation where I was holding a share of TCS, let us say 50 shares of TCS in 2021. I was holding 50 shares of TCS in 2021. In 2023 June, if they had announced dividend, and I've sold this in 2021 itself, so I don't have any shares of TCS presently. Had they announced a dividend in June 2023, will I be eligible to enjoy the benefits of the dividend? The answer is no. This is where the dates are important to assess the eligibility of a shareholder in enjoying the benefits of any of the corporate actions. The 2 most important dates that we need to remember are X date and record date. 2 other dates are payable date and declaration date. So declaration date is when the corporate action is being announced. So in March 20th, 2023, a company would have announced that it is going to pay out dividend sometime in June 2023. So the declaration date will be March 2023. X date and record date are 2 important dates that you need to remember. So X date is the minimum time or minimum date before which you need to be holding or bought the shares. You should have bought the shares before the X date, and you need to be holding it until record date. Until record date, you need to hold it. So you should have bought the shares before X date. You should continue to hold it before until the closure of market on record date. Only then you will be eligible to enjoy the benefits of a particular corporate action. Just like we saw T+1 settlement. T+1 settlement. So you should have bought it at least one business day prior to X date. And you should not sell the shares anytime between X date and record date. You should buy it one day prior to X date, hold it until closure of record date. Usually this span will be 3 to 4 days. So you need to hold it for a minimum of 4 to 5 days. After this, you can do whatever you want after the record date. This will not affect your eligibility. But between X date and record date, you are not supposed to sell the shares. Otherwise, you will lose the eligibility to enjoy the benefits of a corporate action. Remember the statement. And payable date is the date on which the action takes place. Action takes place. If they had announced a dividend, if any company had announced a dividend on the payable date, all the shareholders who were eligible with this criteria will receive the dividend in their bank account. Likewise, if it was a stock split, the stock will be split on the payable date. This is the importance of remembering dates. The most important dates to be remembered are X date and record date. That's all for video 7. Stay tuned for subsequent videos. Like, share and subscribe to Stock Yatra and hit the bell icon to not miss out on That's it for video 7, guys. Stay tuned for subsequent videos. Like, share and subscribe to Stock Yatra and hit the bell icon to not miss out on further updates. Thank you. Jai Hind.